Welcome back to the deep dive. Now, I know what you might be thinking. Taxes.
Uh-oh.
Yeah, exactly. It's a word that can make even the most seasoned financial pro feel a little, well, tense.
It definitely can.
But let's shake off that feeling,
Yeah.
okay? Because today we're diving into something that might sound a bit dry on the surface estimated taxes for 2025. But trust me, it holds the keys to some seriously smart financial moves, especially for those of you with income that doesn't just come from a regular paycheck, you know?
Right, the freelancers, the business owners.
Exactly. So you might be wondering, what exactly are estimated taxes? And maybe more importantly, do I even need to worry about them?
That's the big question for a lot of people.
It is. So our mission today is to demystify Form 1040-ES, yes, but maybe more than that, we're going to unlock strategies to manage these payments proactively, avoid those pesky penalties, and ultimately keep more of your hard-earned money working for you.
Exactly. This deep dive isn't just about, ticking boxes for compliance. It's fundamentally about empowering you.
Empowerment, I like that.
Yeah. Understanding estimated taxes lets you proactively manage your financial picture throughout the year. You can spot potential tax saving opportunities and really leverage the deductions and credits that are available to you.
Okay.
And we're pulling directly from the very latest information for the 2025 tax year, making sure you have the most current tools to, optimize your financial well-being.
Perfect. So let's kick things off with the absolute fundamentals then.
Yeah.
What exactly is an estimated tax, and why does the IRS require some people to pay it throughout the year instead of just like once at tax time?
Right. Well, think of estimated tax as the IRS's way of ensuring a steady flow of tax revenue from income sources that don't have that built-in withholding.
Okay, like from a regular job.
Exactly. If you're a typical W-2 employee, your employer acts as the middleman, right? They take taxes directly from each paycheck. But for millions of Americans today, income streams are much more diverse.
That's for sure.
So if you're a freelancer, small business owner, maybe an investor, or even someone receiving certain government benefits, there's no employer automatically sending your tax dollars to the government.
Right. The responsibility falls on you.
It shifts entirely to you to estimate your income, calculate your tax, and send it in yourself throughout the year. It's essentially about paying as you go, just like a W-2 employee, but, on your own terms.
So it's really about preventing that dreaded huge tax bill come April. That makes perfect sense. What specific types of income typically fall into this not subject to withholding category?
Yeah.
And who specifically has to make these payments?
Yeah, you've hit on a critical point there. The source material, the IRS guidance, gives us very clear examples of income that typically isn't subject to withholding. And it's increasingly relevant in today's economy, like you said. This includes earnings from self-employment, which now very explicitly covers the entire gig economy. And think rideshare drivers, food delivery folks, freelance designers, consultants.
Online creators.
Yep, even online content creators. If you're running your own show, this applies directly to you.
Okay.
Beyond that, it also covers significant income streams like interest from savings or investments, dividends from stocks, rental income from properties you might own,
Right.
alimony, unemployment compensation, and even the taxable portion of Social Security benefits. The core idea is always consistent. If the IRS isn't getting its cut throughout the year via an employer, you're responsible for estimating what you owe and sending it in yourself.
Gotcha.
Now, as for who must make these payments, there are specific rules. And understanding them is really your first line of defense against penalties.
Okay, lay them on us.
Generally, you're required to pay estimated tax for 2025 if two conditions both apply to you. First, you expect to owe at least $1,000 in tax for 2025. That's after subtracting any tax withheld from other sources, like a spouse's job and any refundable credits you qualify for.
So under $1,000, maybe you're okay.
Possibly, yeah. If your total expected tax bill for the year is under $1,000, you might be off the hook for estimated payments.
Okay, condition 1. What's number 2?
The second condition is what we often call the safe harbor rule, and it's kind of like a tactical playbook for avoiding penalties. You must pay estimated tax if you expect your withholding and refundable credits to be less than the smaller of two amounts.
Smaller of 2. Okay.
Option 1, 90% of the tax you expect to show on your 2025 tax return. So pretty close to what you actually end up owing.
90%, got it.
Or option 2, 100% of the tax shown on your 2024 tax return. But, and this is crucial, your 2024 tax return must have covered a full 12 months for this 100% rule to apply. You can't use it if you only filed for part of the year in 2024.
Ah, that 90%, 100% rule, that's where the strategy really comes in, isn't it? It
Yeah.
sounds like it gives you some flexibility, maybe a kind of safety net, especially if you're a bit uncertain about your income for the current year.
Absolutely. This rule is paramount for avoiding those underpayment penalties. It's designed to give you a solid target. Imagine 2024 was a banner year for you, income-wise, but you anticipate a slower 2025. You could strategically opt for the 100% safe harbor based on your lower 2024 tax liability. That gives you significant breathing room and potentially keeps more cash in your pocket during 2025.
Right, you're paying based on the previous lower year.
Exactly. Conversely, if 2024 was a lean year and 2025 is looking like it's going to be huge, well, then the 90% of the current year's tax rule becomes your target. It's really about optimizing your cash flow and avoiding unnecessary costs, rather than trying to blindly predict the future with perfect accuracy. It's a key piece of strategic tax planning.
That's a fantastic distinction. Makes a lot of sense. Are there any special scenarios or exceptions to these general rules that our listeners, maybe with their varied financial lives, should be aware of?
Yes, definitely. There are several important exceptions and special rules that can offer direct financial benefits or, tailor the requirements to specific situations.
Okay.
One really useful exception is if you were a U.S. citizen or resident alien for all of 2024 and you had no tax liability for that full 12-month year.
No tax liability at all.
Meaning your total tax for 2024 was zero. Or maybe you weren't even required to file an income tax return. If that's your situation, you automatically don't have to pay estimated tax for 2025, period.
Wow, that's a direct saving right there. No quarterly payments needed.
Exactly. It's a direct saving in terms of effort and not having to manage those quarterly payments. Then we have specialized rules for certain industries.
Like?
Farmers and fishers. If at least 2/3, that's 66 and 2/3% of your gross income for either 2024 or 2025 comes from farming or fishing.
Okay, a specific threshold.
Right. Then your required percentage for the current year drops from 90% down to just 66 and 2/3%.
Oh, interesting. Why the lower percentage?
Well, it acknowledges the often irregular and, seasonal income patterns in those vital industries. It gives farmers and fishers a bit more flexibility.
Makes sense. What else?
For those who are household employers, meaning you pay someone to do work around your home, like a nanny, a cleaner, a caregiver, and they're considered your employee.
The nanny tax stuff.
Kind of, yeah. You generally need to include those household employment taxes when figuring your estimated tax. But this only applies if you already have federal income tax withheld from other income, like wages or pensions, or if you'd be required to make estimated tax payments anyway, even without including those household taxes.
This is sort of piggybacks onto existing requirements.
Pretty much. It's about ensuring all your tax obligations, including those often overlooked payroll taxes for household help, are covered under one umbrella payment system if you're already in it.
Okay. Anything for higher earners?
Yes, and this is a key one. For higher income taxpayers, the rules tighten up a bit. If your adjusted gross income, your AGI, for 2024 was more than $150,000.
Okay, 150K AGI.
Or $75,000 if you're married filing separately for 2025, then you have to substitute 110% for the 100% rule in that second safe harbor condition we discussed.
So instead of 100% of last year's tax, it's 110%.
Correct. This means higher earners generally need to pay either 90% of their current year's estimated tax or 110% of their prior year's tax, whichever amount is smaller, to avoid penalties.
So a slightly higher bar based on the prior year.
Exactly. It's a critical detail for higher earners to ensure they accurately estimate and avoid potential pitfalls. It encourages those with substantial incomes to contribute a bit more based on their prior year's liability, if that's the lower threshold for them. Definitely a key factor in accurate estimation for this group.
Okay, this is super helpful for understanding who needs to pay, but here's where it gets really interesting for many of us, I think. If you do meet these criteria, you might be thinking, okay, how do I avoid having to do this estimated tax dance altogether? Or, at least make it easier and more predictable, especially if you have, say, a traditional job alongside that side hustle or self-employment income. What are the smart plays here?
That's a fundamental question, and it's one that many people with diverse income streams ask. And the good news is, yes, you can often bypass the quarterly estimated payments entirely, or at least significantly reduce their impact.
Okay.
The IRS actually provides clear methods to help you manage your tax obligations throughout the year, effectively increasing your withholding from other sources to cover any additional income. This is a key strategy for many people to simplify their tax life and avoid that quarterly payment routine.
Okay, so for people who also have a regular W-2 job, what's the simplest, most efficient way to tackle this without adding, more complexity to their financial life?
Well, the primary strategy, and arguably the simplest one, if you also receive salaries and wages, is to simply increase your withholding from your regular paycheck.
Just have more taken out.
Exactly. You do this by submitting a new Form W-4, Employees Withholding Certificate, to your employer. On this form, you can specifically elect to have an additional amount of tax taken out of each paycheck.
There's a line for that, right?
Yep, there's a specific line for extra withholding. This effectively covers any tax you might owe from other income sources, your side hustle, investments, rental income, whatever it is. And it means you likely won't need to send in those separate quarterly estimated payments.
So your employer handles it all.
It's a direct and often overlooked way to integrate your tax planning. You're basically making your employer do the heavy lifting of the tax payments for you, spreading it out evenly over the year.
That sounds much easier.
And this withholding strategy isn't just limited to wages. If you receive a pension or annuity, you can use Form W-4P to adjust withholding from those payments.
W-4P.
For certain government payments, like Social Security or unemployment, there's Form W-4V. And for non-periodic payments or eligible rollover distributions, say from a retirement account, you can use Form W-4R to have tax withheld.
Lots of W-4 forms.
The goal is the same across the board, though.
Right.
Get enough tax taken out throughout the year so you're not hit with a big bill or worse penalties later.
Okay, but how do you know how much extra to withhold? That seems like the tricky part.
That's where the IRS really helps out. They provide a fantastic free online tool called the Tax Withholding Estimator. You can find it easily at irs.gov W4 app.
irs.gov W4 app.
Got it. This tool is critical. You plug in your expected income from all sources, your deductions, your credits, and it helps you determine the correct amount of withholding for your situation. It ensures you're not overpaying, essentially giving the government an interest-free loan, or underpaying and facing penalties.
So it optimizes your cash flow, too.
Precisely. It helps you keep your cash flow optimized by ensuring you're only paying what's necessary throughout the year. It's a really proactive approach to tax management that can save you a lot of headaches later on.
That's a direct and really practical way to manage your taxes throughout the year. Definitely a smart move. But beyond just adjusting withholding, are there any other what's new insights from the 2025 instructions that could directly impact how much tax someone actually owes? Potentially reducing their overall tax burden. This is where the truly strategic tax-saving moves often come in, right?
Absolutely. And what's truly fascinating here is how these annual adjustments, often kind of tucked away in the instructions, can significantly influence your tax picture. They can sometimes lead to those significant aha moments about potential savings.
Yeah.
Staying informed about these changes is just a crucial part of strategic tax management and can genuinely lower your overall tax bill. It's not just about compliance, it's about saving money.
Okay, so what's new for 2025 that we should know about?
Well, for 2025, a major change that benefits many, many taxpayers is the increase in the standard deduction amount.
Yeah, always good to see that go up.
Right. For the vast majority of individuals who don't itemize their deductions, the standard deduction is usually their largest single reduction in taxable income. Knowing these increased amounts ensures you're taking advantage of the maximum possible reduction.
So what are the numbers for 2025?
Okay, let me give you the specific figures.
Yeah.
If your filing status is married, filing jointly, or qualifying surviving spouse, your standard deduction is now a pretty generous $30,000.
30 grand. Wow.
Yeah. For head of household filers, it's $22,500. And for single folks, or those married filing separately, it's $15,000.
$2,000 for single. Okay.
Now, there are also special rules for dependents to make sure they still get some deduction. If you can be claimed as a dependent on someone else's 2025 return, your standard deduction is limited. It'll be the greater of $1,350 or your earned income plus $450, but it can't be more than the full standard deduction amount for your filing status, $15,000 for single.
So it's tailored for dependents.
Exactly. It ensures they get a deduction, but it's adjusted for their specific, often limited income.
What about older folks or those who are blind?
Good question. The standard deduction can also be significantly increased if you're 65 or older or blind. For an unmarried individual, if you meet one of those conditions, either 65 or older or blind, you get an additional $2,000 on top of the regular amount.
An extra $2,000.
Right. And if you meet both conditions, 65 or older and blind, that doubles to an additional $4,000.
Wow, $4,000 extra.
Yeah. For married individuals or a qualifying surviving spouse, the additional amount is $1,600 for each condition per person. So if one spouse is 65 or older, that's an extra $1,600. If both spouses are 65 or older, that's an extra $3,200.
Okay.
And if, say, both spouses are 65 or older and both are blind, that's an extra $1,600 times 4 conditions, so an extra $6,400 on top of their $30,000 base.
That adds up fast.
It really does. These increases are truly significant because they directly lower your taxable income, which translates directly into real tax savings. For most people using the standard deduction, these adjustments are a direct benefit, putting more money back in their pockets.
That's great news. What else is new that impacts the bottom line?
Another key update affects families, the additional child tax credit. For 2025, the maximum additional child tax credit amount has increased to $1,700 for each qualifying child.
$1,700 per child. And that's a credit, right? Not a deduction.
Crucial distinction, yes. It's not just a deduction that reduces your taxable income. It's a direct credit, meaning it reduces your tax bill dollar for dollar.
That's powerful.
For families, this can be incredibly powerful. It directly reduces their overall tax liability, and because it's refundable up to this amount, it could even generate a tax refund.
Nice. Anything else significant?
We also see an increase in the adoption credit or exclusion. For 2025, the maximum amount has risen to $17,280.
$17,280. Wow.
Yeah, it's a significant credit for qualified adoption expenses, or it can be an exclusion from income for employer-provided adoption benefits. It's another powerful way to reduce your tax liability for specific, often very impactful life events.
Is there an income limit on that one?
There is an income phase-out. Your modified adjusted gross income, or MAGI, generally needs to be less than $299,190 to get the full benefit, and it phases out above that.
Okay, good to know. One more.
And finally, this one is particularly relevant for those with higher earnings or self-employment income. The Social Security tax maximum for 2025 is now $176,100.
$176,100.
Right. This is the maximum amount of earned income, that's both wages and net earnings from self-employment, that is subject to the Social Security portion of payroll or self-employment taxes.
So income above that isn't subject to Social Security tax.
Correct. It's still subject to Medicare tax, which has no income limit, but the Social Security tax stops at $176,100 for 2025. This is particularly relevant for those with substantial self-employment income, as we'll dive into more detail on that calculation next. For self-employed individuals, this cap can limit their Social Security tax burden once their income hits this threshold.
Okay.
These updates, the standard deduction, the child tax credit, adoption credit, Social Security max, are all critical details that, when you factor them into your planning, can really help you strategically reduce your tax obligations for 2025.
It's clear that staying informed about these annual changes can be incredibly beneficial, definitely leads to smart financial moves. Okay, now let's get into the real nitty-gritty. How to figure your estimated tax. This is where we break down the actual calculation process, maybe thinking about it item by item or step by step. I know this can sound intimidating, but let's try to focus on the core concepts and the strategic considerations to make it straightforward.
Sounds good. To figure your estimated tax accurately, you'll generally need, like you said, a few key documents. The 2025 Estimated Tax Worksheet itself, that's in Form 1040-ES, the 2025 tax rate schedules, which show the latest tax brackets, and probably your 2024 tax return as a useful guide or starting point.
Okay.
But crucially, remember to factor in those what's new changes we just discussed, especially the standard deduction amounts, because they will directly impact your 2025 calculations. Using the latest numbers helps you leverage all the current benefits and accurately reflect your expected tax situation for this year.
All right, so instead of just reading off a lot of numbers in the worksheet, maybe let's think of it as having a few key stages or building blocks. Where do we begin conceptually?
Exactly. Thinking in stages is a great way to approach it. Conceptually, the first major stage is all about projecting your income and deductions for the year 2025.
Okay, income and deductions first.
Right. You start by estimating your adjusted gross income, or AGI, for 2025. This is your expected total income from all sources, your wages, your business profits, investment income, rental income, whatever you expect to earn, minus certain specific above-the-line deductions.
And what's key here for self-employed people?
Importantly, if you're self-employed, you'll factor in a key tax-saving deduction right at this AGI stage. That's the deduction for 1/2 of your estimated self-employment tax. We'll calculate the SE tax later, but knowing you get to deduct half of it here reduces your AGI. It's a direct benefit that lowers your taxable income right from the start.
Good tip. So estimate AGI, including the SE tax deduction, then what?
Next, you'll account for your main deductions. Here, you have that crucial choice. You either estimate your itemized deductions, things like qualifying mortgage interest, state and local taxes up to the limit, medical expenses above the threshold, charitable contributions.
If you have enough to itemize.
Exactly. Or, for many, many people, you'll simply take the standard deduction. And this is where those increased 2025 standard deduction amounts we just discussed, the $30,000, $22,500, $15,000 plus any additions can really make a big difference. It potentially lowers your taxable income significantly compared to itemizing if your itemized deductions don't add up to much.
So you take whichever's bigger, standard, or itemized.
Whichever saves you more tax, yes.
Yeah.
You also factor in any qualified business income deduction, the QBI deduction, if you're eligible for that. The whole goal of this first stage is to subtract your deductions from your estimated AGI to arrive at your expected taxable income for 2025. That's the number your income tax will be based on.
Okay, stage 1. Get to expected taxable income. Once you have that number, what's the next major step?
The second stage is calculating your baseline income tax on that taxable income figure. You'll use the official 2025 tax rate schedules.
The brackets.
Exactly, the tax brackets. Think of these as a series of buckets or tiers. Not all of your income is taxed at the same rate. Instead, different portions of your income fall into different brackets and are taxed at increasing marginal rates.
So it's progressive.
Right. Your first chunk of taxable income might be taxed at 10%, the next chunk at 12%, then 22%, and so on, up the ladder depending on how high your income goes. It's like filling different buckets, each with its own specific tax rate.
So you have to apply those rates carefully based on the schedules.
You do. And it's important to remember, if you anticipate having qualified dividends or net capital gains from selling investment.
Which are often taxed lower.
Exactly. They usually have preferential lower tax rates. Or maybe if you expect to exclude foreign earned income. In those cases, you'll need to use specific worksheets like the qualified dividends and capital gain tax worksheet, because these types of income are taxed differently. You can't just use the regular REIT schedules for that portion of your income.
Okay, so calculate the tax using the right schedules or worksheets. Does this stage include anything else?
This second stage also includes considering any alternative minimum tax or AMT you might owe, or other specific taxes like the net investment income tax. Though honestly, the AMT affects fewer people now after recent tax law changes, but it's still something to be aware of, especially if you have certain types of deductions or income.
Okay, so baseline tax figured out. Now, after calculating that tax, this is where the real magic happens for reducing your bill credits. Can you walk us through the strategic importance of credits in this calculation? They seem way better than deductions.
Oh, absolutely. Credits are generally much more powerful than deductions. The third major stage in the calculation focuses on applying your tax credits. This is where you truly reduce your tax liability dollar for dollar.
Dollar for dollar reduction, love it.
Right. Remember those expanded additional child tax credits, $1,700 per child? And the adoption credits, $17,280 max, we highlighted in the What's New section. This is exactly where they come into play. You subtract them directly from the tax you just calculated.
Okay.
It's crucial not to include any income tax withholding here, though. Withholding is handled later in the calculation. This stage is purely about identifying and subtracting every non-refundable and refundable credit you expect to qualify for. Things like education credits, energy credits, the earned income tax credit, which is refundable.
So you really need to know what credits you might be eligible for.
Absolutely, because they don't just reduce your taxable income like a deduction does. They directly reduce your actual tax bill. Missing a credit you're entitled to means you're literally leaving money on the table. This is a key area where proactive planning and knowing the rules can yield substantial financial benefits and real tax savings.
That make a huge difference.
Okay.
Okay, now let's tackle that big one you mentioned earlier, self-employment tax. For anyone running their own business, doing freelance work, gig work, this is a huge piece of the puzzle, and honestly, often misunderstood. How do we approach this strategically in the estimation process?
It absolutely is a big one, and you're right, it can be confusing. But understanding it is crucial, not just for compliance, but also because there's a built-in tax advantage. So the fourth critical stage, especially for independent contractors, freelancers, and small business owners, is figuring your estimated self-employment tax.
Okay, break it down for us.
You generally use a separate worksheet for this, the Self-Employment Tax and Deduction Worksheet, which is part of the Form 1040-ES package. But conceptually, here's how it works. First, you start with your expected net profit from self-employment for 2025. This is your gross business income minus all your allowable business expenses.
Your bottom line from the business.
Exactly. Then here's a key calculation, a benefit really. You only use 92.35% of that total net profit for calculating your self-employment tax.
Why 92.35%? Seems oddly specific.
It is specific. It's because self-employment tax covers both the employer's share and the employee's share of Social Security and Medicare taxes. If you work for someone else, your employer pays half. Since you're both employer and employee, this 92.35% factor effectively accounts for the employer equivalent portion, reducing the base amount on which you pay the SE tax. It's a direct benefit to you baked into the calculation.
Okay, so multiply net profit by 0.9235. Then what?
Then you calculate the two components of SE tax on that adjusted amount. First, Medicare tax. You apply a 2.9% rate to that full 92.35% net profit amount. There's no income limit on Medicare tax.
2.9% Medicare.
Got it. Second, Social Security tax. You apply a 12.4% rate, but critically only up to that $176,100 maximum income threshold for 2025 that we discussed earlier.
The cap comes into play here.
Exactly. You take the smaller of your 92.35% net profit amount or the $176,100 limit minus any wages you might have already earned from another job that were subject to Social Security tax. You only pay the 12.4% Social Security tax on income up to that cap.
So if my self-employment profit is $200,000, I only pay Social Security tax on the first $176,100.
That's right, assuming you had no other wages subject to Social Security. This cap is a vital detail for higher-earning self-employed individuals, as it limits their total Social Security tax contributions for the year.
Okay, so calculate Medicare tax and Social Security tax up to the cap, then add them up.
Yep, the total self-employment tax is simply the sum of your calculated Medicare tax and your calculated Social Security tax.
And then comes the deduction, right?
And here's the other powerful tax-saving aspect we mentioned earlier. You get to deduct 1/2, 50% of your total calculated self-employment tax. This deduction is taken above the line when figuring your adjusted gross income back in stage 1.
So it reduces your overall income tax, not just the SE tax.
Correct. It directly reduces your AGI, which lowers your overall taxable income subject to regular income tax rates. It's a significant tax benefit that many self-employed individuals, especially when they're starting out, sometimes overlook. It recognizes that the employer half of the SE tax is effectively a business expense.
Oh, it's huge. What if both spouses are self-employed?
Good point. If you and your spouse make joint estimated tax payments and both have self-employment income, you each figure your own self-employment tax liability separately on your own respective incomes, and then you combine the results to get the total SE tax for the estimate. You also each calculate your own deduction for 1/2 of SE tax separately.
Okay, so it requires some careful calculation, especially with that 92.35% and the 50% deduction.
It does, but getting it right is essential for accuracy and for maximizing your tax savings. It's a prime example of where that item-by-item precision in tax planning translates directly to real savings.
That self-employment tax calculation clearly has a lot of moving parts, but understanding that 92.35% adjustment, and especially the 50% deduction, is a huge takeaway. Okay, what about other potential taxes? And then how do we kind of tie all these pieces together to determine our final estimated payment amount?
Right. After calculating your income tax, stage 2, subtracting credits, stage 3, and figuring your self-employment tax, stage 4, you'll then add in any other specific taxes you expect to owe.
Like what?
Well, this might include certain household employment taxes, but only if they meet specific conditions we touched on earlier. It's important to be careful here, though. Some taxes, like, say, uncollected Social Security and Medicare tax on tips you didn't report to your employer, or the recapture of a first-time homebuyer credit, are not included in your estimated tax payments.
Oh, okay, so you don't estimate everything.
Not quite everything. Those specific items I mentioned aren't required until you file your final income tax return by the due date. Including them in estimates isn't necessary and could mean you're overpaying early. This distinction helps you manage your cash flow throughout the year and avoids paying estimates on taxes that aren't technically due until later.
Good to know. So after adding the necessary other taxes, what do we have?
Finally, we arrive at your total estimated tax for 2025. This represents your full expected tax liability for the year after factoring in all your projected income, deductions, credits, self-employment tax, and those other necessary taxes. If this total calculation comes out to 0 or less, maybe due to large credits, then you simply enter 0.
Okay, that's the total expected bill for the year.
Yeah.
But that's not necessarily what I have to pay in estimates, right?
Sure.
Because of the safe harbor rules.
Exactly right. Now, to protect yourself from penalties, you need to determine your required annual payment to avoid a penalty. This is the crucial figure for managing your payments. It's the smaller of either. 1. 90% of your total estimated tax for 2025, the number we just calculated, OR2. 100% of the total tax shown on your 2024 return, as long as it covered 12 months.
Or 110% of the 2024 tax if you're a higher income taxpayer.
Precisely. Remember that 110% rule for AGIs over 150K or 75K MFS. Meeting this smaller threshold, whichever calculation gives you the lower required payment, is how you definitively avoid an underpayment penalty. It's a direct form of saving by proactively preventing those unnecessary extra costs.
Okay, so figure out that required minimum payment then.
Then you account for any tax that's already being withheld on your behalf during 2025. This includes withholding from your wages, maybe from that W-4 adjustment we talked about, pensions, annuities, certain government payments, etc. You subtract this total expected withholding for the year from your required annual payment value.
Right, because that's already covering part of the requirement.
Exactly. And finally, the worksheet provides a clear test. Is an estimated tax payment required? There are 2 conditions where you don't need to make estimated payments. 1, if your required annual payment after subtracting your expected withholding is 0 or less. 2, or R, if your total estimated tax for the year, from Stage 5, minus your expected withholding is less than $1,000.
That $1,000 threshold again.
Yep. If either of those conditions is met, the worksheet tells you that you are not required to make estimated tax payments for 2025. This provides a clear guideline to know if you can skip this whole quarterly process altogether.
Okay, that's a really clear path through the calculation and figuring out the requirement. It's definitely about building a comprehensive financial picture for the year. What about those folks with highly variable income, though? Like maybe a realtor whose income spikes in the summer, or a freelancer with big projects landing unpredictably. Is there a strategy for them that's more flexible than just trying to guess the whole year's income back in April?
Absolutely. And this is a fantastic strategy, often underutilized, for people in exactly those situations, uneven income throughout the year, maybe due to seasonal businesses, commission-based sales, or perhaps a large capital gain from selling stock that occurs later in the year. It's called the annualized income installment method.
Annualized income.
Okay.
How does that work?
Instead of paying 4 equal installments based on your estimate for the entire year, this method allows you to calculate your income, deductions, and credits based on what actually happened during specific periods within the year.
So you figure it out period by period.
Pretty much. There are 4 payment periods ending March 31st, May 31st, August 31st, and December 31st. For each payment due date, you annualize your income and deductions earned up to the end of that period. So if your income is low in the first quarter, your required payment for the April 15th deadline might be very small, or even 0.
Because you haven't earned much yet.
Exactly. Then, if your income surges in the second period, your June payment would reflect that increase. It allows you to lower or even eliminate required payments in those earlier periods when cash flow might be tight, and then adjust upwards as your income actually materializes later in the year.
That sounds way better for managing cash flow.
It really is. It's a much smarter way to manage your cash flow if your income is lumpy. You keep your money working for you longer, and most importantly, you avoid penalties that might arise from underestimating early in the year when income is low, but which then picks up significantly later. It requires more calculation throughout the year using Form 2210F for farmers fishers, or Schedule AI within Form 2210 for others, but it's a key tax optimization technique that offers tremendous flexibility and accuracy for those with fluctuating incomes.
That detailed breakdown of the worksheet stages and the annualized method is incredibly helpful. It really shows the precision involved, but also the strategic options. Okay, so let's say you've done the math. You know roughly what you owe each quarter, or maybe you've decided to just adjust your W-4 instead. And how do you actually make these estimated tax payments if you need to? And perhaps more importantly, for peace of mind, what happens if you miss a deadline or accidentally underpay?
Right. The practical logistics and the what-if scenarios are just as important as the calculation itself. And the good news is the IRS offers multiple ways to pay. Choosing the right one for you can ensure timely delivery and give you peace of mind, which directly helps you avoid those unwanted penalties.
Okay, first things first. When are the payments actually due?
Okay, let's nail down the payment due dates. For most calendar year taxpayers, which is the vast majority of people, the estimated tax payments are due quarterly, and these dates are pretty firm. The first payment, covering income from Jan 1 to Mar 31, is due April 15th, 2025. The second payment, for income April 1 to May 31, is due June 16th, 2025. June 15 is a Sunday. The third payment for income June 1 to Aug 31 is due September 15th, 2025. And the fourth payment, covering Sep 1 to December 31, is due January 15th, 2026.
April, June, September, January. Got it. What if a date falls on a weekend?
Good catch. If any of these dates happen to fall on a weekend or a legal holiday, the due date automatically shifts to the next business day, like that June 16th date for 2025.
Okay. Is there any way around that January payment?
There is actually a clever exception for that final January 15th payment. You don't have to make that specific payment if you choose to file your complete 2025 tax return, Form 1040 or 1040-SR, early by February 2, 2026, and you pay the entire balance due with your return at that time.
So file early and pay in full by early Feb and skip the Jan 15 payment.
Exactly. It wraps everything up a bit sooner. And remember those special rules for farmers and fishers? They generally have until January 15th, 2026 to pay all of their estimated tax, or they can file their 2025 return and pay the total tax due by March 2, 2026. If they do one of those, estimated payments aren't required to avoid a penalty for them.
Okay, dates are clear. Now, how about the actual methods of payment? What are the most convenient and, maybe more importantly, secure ways to get that money to the IRS?
The IRS really, really wants to make it easy for you to pay electronically, and they strongly emphasize paying online for both convenience and security. It's faster, safer, and you get confirmation.
So what are the online options?
You have several excellent online methods. IRS Direct Pay. This is probably the simplest for many. It's a fantastic, no-cost option right on the IRS website. You can transfer funds directly from your checking or savings account. It's simple, fast, completely secure, and you get immediate confirmation.
Direct pay, no fees. Sounds good.
You can also pay by debit card, credit card, or digital wallet like PayPal or Click to Pay. These options are available online or by phone through IRS-approved third-party payment processors. Just be aware that these service providers will charge a small processing fee. The IRS itself doesn't get any of those fees, but it's a trade-off some people make for the convenience or maybe earning credit card points.
Okay, so fees possible with cards wallets.
Electronic Fund Withdrawal, EFW, is another great option. It's a seamless e-Filey pay method. If you're filing your federal taxes electronically using tax prep software like TurboTax, H&R Block, etc., or through a tax professional,
Which many people do.
right, you can often schedule your estimated tax payments directly as part of that e-filing process for your main return, or sometimes even just for the estimates themselves, depending on the software. It's all done in one go.
Integrated with the software.
Yeah.
Nice.
Now, if you find yourself in a tough spot and realize you can't pay your full tax bill by the return due date, you can apply for an online payment agreement, OPA, through irs.gov OPA. This lets you set up a monthly installment plan, but just know there's usually a user fee involved to set that up.
Okay, payment plans are an option if needed.
Another excellent no-fee option, especially if you make regular estimated payments or other federal tax payments, is the Electronic Federal Tax Payment System, EFTPS. This requires a one-time enrollment process, which takes a little setup time initially.
EFTPS, okay.
But once you're enrolled, you can easily pay your taxes online or by phone directly from your designated bank account. It's ideal for scheduling payments far in advance or setting up recurring payments if your estimates are consistent. Businesses often use this.
Sounds robust.
For mobile users, you can download the official IRS To Go app and make payments right from your phone using direct pay or debit credit card option.
App option 2.
And one of the most comprehensive tools for managing your overall tax situation is your personal online account at irs.gov account. This isn't just about paying, it's about seeing your entire tax picture. You can view the amount you owe, check your payment history for the last 5 years, access key tax records like transcripts, view digital copies of certain IRS notices, and even manage your communication preferences with the IRS.
Wow, that sounds really useful for staying organized.
It is. Accessing your online account isn't just about making a payment, it's about gaining complete oversight of your tax situation, which is invaluable for planning future payments, verifying past payments, and identifying potential savings or issues.
Okay, so lots of online ways. What if someone really prefers not to pay online?
If online isn't your preference, there are phone methods too. Primarily, this involves using debit or credit cards through those IRS-approved service providers. Again, fees apply. Or using the EFTPS system by phone once you're enrolled.
And cash. Can you pay in cash?
You actually can, but not by mail. The IRS has specific retail partners where you can make cash payments. You get instructions and a payment barcode online at irs.gov Pay Cash, then take that to a participating store. Just a very important caution. Never, ever send cash payments through the mail to the IRS. It's just not secure.
Okay, good warning. What about the old-fashioned way? Check or money order?
You can still pay by check or money order using the estimated tax payment vouchers, Form 1040-ES vouchers. While the IRS strongly encourages electronic payments because they're safer, faster, and easier to track, these paper vouchers are still an option.
So you fill out a voucher for each payment.
Yes, there's a separate tear-off voucher for each of the 4 due dates in the Form 1040-ES package. You'll need to carefully print or type your name, address, and social security number on the correct voucher for that payment period. Make sure your check or money order is payable to United States Treasury.
United States Treasury, got it.
And crucially, on the memo line of your check or money order, clearly write 2025 Form 1040-ES and your social security number again. This helps ensure it gets credited correctly.
Details matter with paper checks.
They really do. You also have to mail your voucher and payment to the correct IRS processing center based on your state of residence. The addresses are listed in the Form 1040-ES instructions. For example, if you live in Florida or Georgia, you send it to Charlotte, NC. But if you're in, say, Illinois or New York, it goes to Louisville, KY, California, and Ohio, go to Cincinnati. It's quite specific.
So you definitely need to check the instructions for the right address.
Absolutely. And maybe an odd detail, but they caution against sending checks for $100 million or more. You need special arrangements for those.
Okay, noted. Don't send a $100 million check without calling first.
Right. But seriously, while checks are an option, the IRS really does recommend online payments for speed, security, and confirmation.
That's a lot of options, which is great. It really does sound like the IRS wants to make it easy to pay, offering multiple convenient methods. The key, it seems, is just being proactive. But what if your initial estimate was off? Life happens, income changes. Can you adjust mid-year? And what are the actual consequences, the penalties, if you underpay or pay late?
You absolutely can adjust, and in fact, you should amend your estimated tax payments if your income, deductions, or credits change significantly during the year. This is a critical part of smart, ongoing tax management, not just a set-it-and-forget-it thing.
So how do you adjust?
To do this, you simply refigure your total estimated tax due for the year using the 2025 estimated tax worksheet with your updated information. Then you adjust your remaining quarterly payments accordingly to catch up or slow down as needed. The instructions for Form 1040-ES and IRS Publication 505 provide guidance on how to properly spread that adjusted amount across the remaining payment periods.
Does adjusting fix any past underpayments?
That's an important point. Be aware that if an estimated tax payment for a previous period was less than what it should have been based on your income up to that point, especially if you're using the annualized method, you may still owe a penalty for that specific underpaid period when you file your final return, even if you catch up later.
So catching up later doesn't always erase an earlier shortfall penalty.
Not necessarily for the earlier periods calculation, no. That's why trying to be reasonably accurate each quarter or using the annualized method if your income fluctuates is important.
Okay, so about those penalties, what exactly triggers them?
The IRS can impose an underpayment penalty if you didn't pay enough estimated tax for the year based on those safe harbor rules, the 90%, 100%, 110% rules, or if you didn't make the payments on time, or if you didn't pay the required amount for each payment period.
So it's about both the total amount and the timing.
Correct. The penalty is generally calculated separately for each required installment payment date. It's essentially like an interest charge on the amount you underpaid for the number of days it remained unpaid. The rate can fluctuate slightly based on market interest rates.
Can the penalty ever be waived?
Yes, sometimes. The penalties can potentially be waived under certain specific circumstances, such as if the underpayment was due to a casualty, disaster, or other unusual circumstance, and it would be inequitable to impose the penalty. There are also waivers possible if you retired after reaching age 62 or became disabled during the tax year or the preceding year, and the underpayment was due to reasonable cause and not willful neglect. These waiver requests are usually made using Form 2210, underpayment of estimated tax by individuals, estates, and trusts when you file your return.
Okay, so there are exceptions, but generally you want to avoid it.
Yeah, definitely. This really underscores why being proactive with your estimates and utilizing tools like the IRS tax withholding estimator or the annualized income installment method, if applicable, is so incredibly important. Accurate planning saves you money directly by avoiding penalties, and it certainly saves you stress. It prevents that financial leakage that comes from unnecessary costs. Indeed. And, knowledge is really most valuable when it's understood and then actually applied. What we've discussed today about 2025 estimated taxes covering everything from who needs to pay to how to strategically calculate the tax using that worksheet thinking, focusing on deductions and credits, and understanding how to make the payments. It isn't just about, compliance or following rules.
Right. It's more than just checking boxes.
It really is. It's about leveraging the nuances and details within the tax code. Things like those increased standard deductions we talked about, all the available credits, understanding the safe harbor rules to avoid penalties, and using powerful techniques like the annualized income method if your income isn't steady. It's all geared towards actively managing your financial well-being throughout the entire year.
So shifting from reactive tax filing to proactive tax planning.
Precisely. It's about moving beyond simply filling out forms come tax time, to strategically planning your year, to minimize surprises, maximize your deductions and credits, optimize your cash flow, and ultimately keep more of your money. This is just a crucial part of smart financial management for anyone with income streams beyond a simple paycheck.
So thinking about our listeners, what does all this mean for you? Well, if you have income that isn't subject to withholding that side hustle, rental income, investment income, your own business, taking the time now to estimate your 2025 tax using the principles we discussed, using that Form 1040-ES worksheet as a guide, and exploring those options like adjusting your W-4 withholding if you have a job, or considering the annualized method if your income swings wildly. Doing that can save you from a major headache and potentially significant penalties down the line.
Absolutely. A little planning goes a long way.
It really does. It's about being informed, taking control of this part of your financial journey. Our deep dive today has hopefully provided the nuts and bolts, the item-by-item thinking, and the strategic insights. Now, really, the ball is in your court to apply this knowledge and make those smart financial moves for 2025.
Well said.
And that leaves us with a final thought. Considering all the proactive steps one can take with something often seen as complex as estimated taxes, the estimation, the adjustments, the strategic planning, it makes you wonder, in what other areas of your personal finances could a similar level of consistent estimation, regular adjustment, and strategic foresight lead to greater peace of mind and ultimately significantly better financial outcomes? Something to think about.
Definitely food for thought.
Thanks so much for joining us on this deep dive into 2025 estimated taxes. Until next time, keep learning and keep making those smart financial moves.